Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 28th of June. I'm Daniel Lam, your host for the podcast. Earlier this week, we spoke about our second half outlook, which we published last Friday. The key change in our macro view is the delay to our timing of the US recession. We basically push it out by a quarter to the first quarter next year due to excess household savings. So various estimates show that US households still have more than $1 trillion of excess savings, which was built up during the pandemic, and they continue to spend. This may sustain the consumption-led growth longer than initially expected. However, we're still expecting a 70% probability of recession over the next 12 months. Leading and therefore early warning economic indicators, such as new orders to inventory ratio, initial jobless claims, the pace of hiring of temporary workers, and consumer confidence, have been showing a heightened risk of a recession in the past few months. The latest warning sign is the rising unemployment rate. So historically, when the US unemployment rate rose on an annual basis, a recession became imminent. And when the 3-month moving average rose 50 bips from its lows in the previous 12 months, a recession would have started. So far, the US jobless rate has risen on a year-on-year basis, but the 3-month moving average is barely above its 54-year low of 3.4%, which was hit in January this year. Meanwhile, a leading indicator of the overall unemployment rate is the jobless rate of permanent job losers. So these are the workers whose employment ended involuntarily and are not on temporary layoff. Historically, when this rate rose more than 30 bips from its cycle lows, a recession would have started. Now the rate has risen 23 bips so far. So these would be the amber indicators and would support the aforementioned probability of a recession. As a result, we expect the second half to be a tussle of narratives between 1. The no-landing scenario of avoiding a US recession, which favors chasing equities and risky bonds higher, versus 2. The approaching and imminent recession, which favors strategies such as holding cash. Now, we believe investors should take a middle ground here. Investors should prefer high-quality bonds because there is a clearer risk-reward relative to other assets. So they offer an attractive yield. Bond yields are likely to fall as economic growth slows, so prices of bonds are likely to rise. And their returns are likely to be less impacted by a slightly higher Fed peak rate, given the cushion from the already high current yields on offer. More importantly, we believe market conditions today favor locking in the yield on high-quality investment-grade bonds before slowing growth eventually pushes yields lower. This is a key advantage high-quality bonds have over cash. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.